Hey guys, and welcome back to my channel. This is a continuation of a series we have in this channel called Understanding Forex, in which we go over different Forex concepts and strategies in hopes to help you better understand the Forex market. In this video, we will be explaining what a moving average cross is and as well as its advantages. So let's get started. Before we begin, what even is a moving average? Well, there are two types of moving average to begin with. A simple moving average, which if you don't know what it is, I already have a video explaining what it is and how you can use it to trade, and an exponential moving average. I also just posted a video about that not too long ago. So a moving average pretty much helps smooth out data, making it easier to see the trend and trading signal according to Investopedia. So there are short-term, medium, and long-term moving averages, and just like the name suggests, it applies to whichever horizon you are interested in. So if you're in short term, you are going to use the short term moving average and so on. The most common for short term moving average are 10 and 20. The most common for the medium is the 50, and most common for the long term moving average is usually 100, 200, and some people even go as far as 500 according to Investopedia. So now that we have our foundation, the rest is pretty simple. So a moving average cross would, for example, if I trade a shorter time frame, I will place a 10 moving average and then a 20 moving average. The cross happens when the faster one, in this case the 10 moving average, moves above or below the slower one, which in this case is the 20 moving average. There's something called the golden cross in the stock market and the bond market. The golden cross holds more weight, or is deemed extremely important compared to when it happens in the Forex market, at least in my opinion. Because again, Forex traders use different moving averages for different strategies, so there's not really one set rule as opposed to like the stock market or the bond market. Golden cross is the short-term moving average. Typically the 50 crosses above the long-term moving average, typically the 200. Is usually a buying signal and also an indicator of maybe there might be good times ahead. And then it's the opposite, which is the dead cross, and again pretty much similar to the golden cross, pretty much when the short term goes below the long term, so you might be looking for a sell. Those two pretty much sums up what a moving average cross is. You set up two moving averages the side, and when the faster one crosses above, you might want to look for a buy, and vice versa, when the faster one moves below, you might want to look for a sell. So let's go to the markets and test this theory out. So for this example, I'm going to be using the golden cross that we were explaining earlier, which is the 50 and the 200. So let's see if we get an entry. So it looks like we might have an entry over here. We kind of already missed the move though. So we have a bunch of continuous bullish confirmation. So we have a bullish engulf followed by a bullish hammer followed by another bullish confirmation. So I would probably take this trade. I would have likely taken it on this day, but since the replay already showed us what's going to happen, I'm going to take it on this day. So I'm probably going to take profit somewhere around here, and then SL. I'm going to try and avoid this because we have a lot of action going on here. We have these wicks over here, and then these as well, and then these as well. So probably going to place it somewhere around here, which also I feel like it's going to get hit because you have these shadows and these wicks going on here. But let's see how this plays out. So remember, TP over here, SL somewhere around here, and we have TP that has gotten hit. So let's see if we can find one more example before the day ends. So I would have probably taken this trade, but again, it already played out, so hindsight is always 20/20 is what I like to say. So let's see for one more entry before this video ends. Friday, Monday. This actually doesn't look that bad. Let's give it one more candle. Nah. Okay. So we just have a consolidation here going. This doesn't look that bad either. Keep going. Okay, looks like we have a huge retracement going on. Okay, and now it looks like we have a buy signal. Oh, it's Thursday, never mind. Okay, nothing as of yet. Okay, still nothing, and so I would probably enter on this day right here. So bullish hammer followed by a big bullish go followed by another bullish hammer. So I would enter here, stop loss somewhere around here, which I feel like might also get hit. But the reason why I put it here and not here is because if you stretch back a bit, you could see we have a bunch of shadows here, a bunch of resistance here. Same thing over here, a lot of shadows, which is why I opted for this zone instead. But even this zone too, there is still resistance on that zone. But I would rather take this play than put it over here. So stop loss over here, and then TP probably, I'll say over here, between this zone or this zone. I wish I had a price action over here to kind of help me out, but either between this or this, somewhere around here. So let's see how this plays out. And we got the move we're looking for, which is fantastic. We had two big bursts and gave us our entry and gave us our take profit. So pretty much that's what a moving average cross is. As you can see, the two trades I took were from the golden cross strategy, not the strategy, but the golden cross that we went over, which is when the faster moving average is above the slower one, which in this case is the 50 and the 200. The 50 one is the blue line and the 200 one is the red line. So guys, that's gonna be it for this video. If you like what you saw, leave a like, comment down below any thoughts, questions, concerns, any input, and I'll see you guys next time.